Ah, yes, the stock market. Truly, humanity's greatest achievement in transferring money from one bucket to another. And nowhere is it on more spectacular display than the SPAC, the Special Purpose Acquisition Company. I am Sir David Attenborough, brother of Richard Attenborough, creator of Jurassic Park, and this is Time in the Market. Well, thank you. Thank you, David Attenborough. And no, that wasn't David Attenborough. It was just a spot on impression of the great man himself. But hey, David Attenborough, if you're out there watching my amazing channel, which my mom says is a good way to spend an hour if you're really, really bored, then, if you want to narrate for me, hit me up. We're going to do something slightly different today on the channel. And welcome to Time in the Market, the investing channel with a long-term perspective in mind. We're going to talk about SPACs today in more detail, what they are, why I like them, how they function, and how you can use them to potentially make money. As always, please remember, I am not a qualified financial advisor. I am just doing this for fun, and I also do amazing impressions, as you can tell. Please talk to a qualified financial advisor before making any investment decisions. But with that in mind, let's dive into SPACs. So what the heck is a SPAC, guys? A SPAC, or a Special Acquisition Purpose Company, is essentially a black check company, a holding company. It is a SPAC formed by a sponsor or group of wealthy dudes who want to get more wealthy in order to raise funds via an IPO, which are then used to take a company public via a reverse merger. These funds are generally raised in multiples of $10 per share, and this is usually referred to the net asset value of the SPAC. After all, once they raise the money, they put that $10 in a trust account, and then they use that money to try to find a company and take it public. The way they go public is via an IPO in the form of units. These will be something like ABCU, so ABC with the name of the SPAC. Units are composed of a common share and a warrant and are used to raise money via the primary market. Usually units are going to be sold to hedge funds, etc., and they're designed in a way to attract money and help the SPAC raise the assets that it needs to actually function. They are composed of a common share, like I said, which is what you typically think of when you think of a stock. It's one share of the SPAC, which is going to be equivalent to about $10 in trust, and also a warrant, which is the option to buy a share of the future company that they acquire at $11.50. And these are usually shown in an S1, something like this. We're looking at SRNG, which recently took Ginkgo Bioworks public. These guys are issuing 172.5 million units at $10 per pop. Most SPACs are going to be trading at $10 per pop, just to keep it simple. These include 172 million of Class A ordinary shares and also 1/5 of one redeemable warrant per unit, or 34.5 million warrants, which are then equivalent to 34.5 million shares at $11.50 if people choose to exercise them. So these units go to hedge funds. You can buy them on the secondary market once they start trading, but for the most part, unless you're rich, you have connections, what have you, you won't be able to access units at exactly $10 per share, which is what they're sold at. Once they are traded on the secondary market for about 52 days, they split into the underlying assets, which is the common share and the warrant. I won't rehash what those are again, but this is usually when most investors try to play in the SPAC space. The common share reflects the underlying asset, which in this case is the $10 held in trust, and the warrant reflects that option to buy whatever company they eventually acquire at $11.50. So obviously, if you are purchasing the warrant or holding the warrant from your units that split, you want the company to eventually be more than $11.50, or the warrants will be effectively worthless for you. Warrants will generally trade, anywhere between 50 cents to $1.50, depending on how hot the company is and how much the share cost. They'll go up in value as the common share price goes up in value. Kind of not exactly a one-to-one relationship, but they do certainly follow the trend of the price. The lower the price of the common share, the lower the price of the warrant. The higher the price of the common share, the higher the price of the warrant. They are a more of a risk driven play on a SPAC. If you're willing to put some money there, you do have the opportunity to make a lot more money with a warrant than a common share with a smaller initial investment. However, they can also obviously go to zero. If the price never reaches 11.50, your warrant is effectively worthless. That's the high level overview of what the SPAC structure looks like. But what happens once the money is actually raised? So these SPAC sponsors go to whomever, they raise a certain amount of money, they do the split, and now they have anywhere from 0 to 24 months to find a company to merge with. Essentially, hey, we've raised a bunch of cash as a SPAC. Now we have to do something with the cash, or we have to redeem it to investors if no deal is made. So the redemption feature is a big part of why SPACs are an interesting investment, and we'll talk about that in a second. But first, let's talk about why SPACs exist in the first place and why they got so popular recently. So SPACs are, again, an alternative vehicle to raising money on the primary market for companies. They do have a purpose, right? They allow companies to raise capital and access liquidity in the public markets and go public via an easier means than a traditional IPO. There's less filing requirements with a SPAC, so companies can somewhat obfuscate some of their information more so than they could with an IPO. They have to release less information, but there's still a decent amount of information they have to release. However, SPACs weren't really that popular with 1 to maybe a dozen SPACs going live between 2009 and 2016. They ticked up a little bit between 2018 and 2019, but they really exploded in 2020. There's already 596 SPACs that are live and searching in 2021. So why was that? A couple of reasons. One, there were a couple of high profile successes like DraftKings, which returned 300 to 400% for early investors. That really got the ball rolling on really pushing demand for SPACs. And when there's a demand, people are going to be willing to fill that supply. Another reason for that is that, hey, it's a good way for rich people to make more money. And if there's a demand for this product suddenly, because either growth names are becoming a bit too more expensive, a lot more companies are looking for ways to go public, and SPACs fill that void, or bond yields are suddenly zero and people need to find alternative investments to invest in and make a return, maybe SPACs will fill that void. The reason SPAC sponsors are more than happy to do that is because of something called founder shares. So whenever somebody sponsors a SPAC, takes it public via IPO to raise cash and find a company, they essentially pay a very small amount, $25,000 in the case of this one, or approximately 0.0006 cents per share to cover some offering costs, and they get about 43 million shares in the case of this SPAC. Usually it's somewhere in the neighborhood of 20 to 25% of overall shares are given to the SPAC sponsor for, doing the due diligence, for running the SPAC, for having some expenses out there in regards to making sure that the SPAC is running along smoothly and finding a company down the line. So they do put some money up front. They do put some expenses beyond that towards the process of finding a company. But as a result, if they find a deal, they get quite a bit of shares in the new company, and that's really profitable for them. If you look at the $10 net asset value and you look at the 43 million shares that they're essentially getting $430 million in founder shares if the price stays at $10. Again, they only get that if a deal is consummated, so there is an incentive for them to find a deal. Otherwise, they have to redeem that money to investors if no deal is made within the timeline allotted to them by the SPAC outline. Usually that timeline is anywhere from 18 to 24 months. They don't have to take that long. Most do it a lot sooner. And if they do hit that upper end, they can also have a vote with the shareholders of the SPAC that say, hey, we're kind of close to a deal, give us a 6-month extension, whatever. There is certainly an incentive for SPAC sponsors to find a company, and all of them pretty much do because they want to get those founder shares, and they want to get paid after all. That's really why they exist. They exist to find a company, and if they didn't do it, what were they doing with their time? There's no point. However, the redemption feature does serve a second purpose when it comes to a SPAC. So let's assume that a couple of months pass, they find a company, sign a deal,
release information. At this point, you get something like this, where you have a transaction summary that kind of outlines, well, why are we making this deal? What are we doing? Why do we feel it's a good deal? It's kind of a very much a salesy pitch to the investors to say, hey, this is a good deal. We think it's a good deal. We think it's valued fairly against the market. And we think it's going to go up and be worth more than $10 when we actually make the deal. However, if you disagree, you have something called a redemption. There is a period of time before the vote is cast. So when a SPAC finds a company that they want to acquire, they release information, they set a vote to confirm the deal, and then the deal is made. So the important part of this whole timeline is this redemption piece, and that really is what makes SPACs an interesting investment idea for a lot of investors. And what a redemption is basically the opportunity to get your money back before a deal is finalized. Essentially, you're saying that, hey, I don't like the deal you've made, and I want my money back. You can have your shares back. I know you're holding $10 per each share that I own in a trust. Give me my money back because the deal sucks. This is one that I got for BarkBox, which is potentially merging. There's a special meeting held on 5/28/21. However, if I think the deal sucks, if I don't like BarkBox Inc., I can call my broker, get in touch with my broker before 5/26 and essentially say, hey, I want my $10 back. And as disclosed in the proxy statement, all of the SPACs will have something like this in there. You have the right to redeem your money before a certain time, before the merger takes place. So essentially what happens there is the SPAC allows you to take your money out, right? That's the way this is structured. You know, they raise money, they have a certain amount of time to merge with a company, and when they merge with the company, they give you some information about it. But if you don't like it, you can redeem that money. So you essentially get your $10 back, or around $10. You know, there might be more because of interest. There might be less if the SPAC for some reason used it for some expenses, but that certainly shouldn't happen if it's an up and up SPAC. However, it's generally going to be mostly $10, and that's always before the deal is confirmed. Once the vote happens, the deal is made, assuming it passes, the company de-SPACs, this is important, starts trading under its own ticker, and all bets are off. So that's important, and I'll tell you what that means. So the reason SPACs are often an interesting investment vehicle is simple. One, when you buy a common share of a SPAC, you're buying $10 worth of cash that is being held in a trust that shouldn't be touched. That means that because you can get that $10 back before a deal is finalized, your risk in buying that share before that redemption is relatively low. A common share of a SPAC can go below $10, mainly due to people wanting to get their cash back and not wanting to wait for the redemption feature to happen. However, it often doesn't go too far below $10 because at the end of the day, what you're owning at the time when you're buying a SPAC pre-deal is you're owning $10 in cash with the possibility of upside if the company they find is good and well received by the market, and limited downside because you have the protection of the redemption feature. However, that only applies until the redemption feature date passes. You know, in this scenario, once you're past 5/26 or 5/25, whatever the date is, and the vote happens, the company de-SPACs, the SPAC is no longer traded on the fact that it has $10 in cash. That $10 in cash is now part equity in the new company, part cash on the balance sheet of the new company, part whatever it was used for. It is no longer $10 in cash. It is now traded on the merit of the company that they acquired, and all bets can be off. And that is the important thing to know about SPACs. Because if you look at the completed list of SPACs in 2020, there's a lot of them already that are down 80%. And that kind of shows you that SPACs can be a risky proposition because of a variety of reasons, right? There is a incentive for the SPAC sponsor to make a deal. Remember, they're paying less than a cent for these shares. Even if for some reason they didn't sell them right away, they're still making a profit even when the SPAC is down 85%. That's an important thing to remember, right? They certainly care that the SPAC is down so much because it might make it harder for them to issue more SPACs in the future. And there's a lot of serial SPAC sponsors that have 7, 8, 9 multiple SPACs already. But at the end of the day, they're making money. The hedge funds who probably bought the units and then sold them on the secondary market to individual investors like us for 1 to 2 to 3% profit in a couple of days. They've made their money. People who are involved in the expense side of things, the underwriters, etc., they're making money, and the plan sponsors are making money. However, the investors might not be if it's a bad return. And you know what they say: 3 out of 4 ain't bad. So if the investors screwed, everybody else made their money, and that's somewhat why SPACs get a negative connotation sometimes, and it's not wholly unwarranted. However, on the back end, if you look at some of the successes here, Playboy, which I own, up 372%. Betterware, de-Mexico, which I've never heard of, but good for them, up 344%. DraftKings, which I own, up 342%. A lot of other SPACs up 100+%. This is why SPACs are interesting, right? They give you the option to get into these companies at an early point before any other investors can get in. And this is why buying some of these companies at $10 can be a really good long-term play if the company is a good deal and you do your own due diligence and the market responds favorably. Even if you buy it at $10, the deal is made, the market pops $1 to $2 and you sell it, you've still made a bunch of money. If the deal is made and the deal sucks, the market hates it, it's still not going to go far below $10 until the redemption passes because you have the right to redeem your $10. After that, it could certainly tank and all bets are off. But until then, the risk reward is pretty good. That's why SPACs are interesting to me. However, there are a few caveats here. One is that SPACs can get ahead of themselves. That's what happened last year and why some of these SPACs launched when they did. It was so easy to make money in SPACs for a couple of months. You could buy any random SPAC for $10, get a deal announcement, have it pop to $12 no matter how mediocre the deal was, make 20%, move on to another SPAC near $10 and continue doing that. That lasted for a while until people got wise to it. And these common shares that were holding $10 in cash suddenly started going up and up in value, right? You could buy a SPAC that was nothing more than $10 in cash for $13 to $14. And some of my SPACs that were pre-deal, pre-anything, that just had $10 in cash on the book started trading at $13 to $14. So I was like, well, this is dumb, because when I was buying them at $10, the risk reward was pretty good, right? If the deal is announced and it pops, I get some money, and if I sell right away and if I don't like the deal, or I can hold the company for the long term. But if it sucks, my floor is around $10. Now, if I'm buying this for $13, if the deal sucks, I could potentially lose 30% right off the bat. So I started selling some of my SPACs at that point because the risk reward wasn't good anymore. And I still held a bunch. I wasn't like a genius and sold at the top, because SPACs, as they have a tendency to do when things get kind of bubblish, crashed pretty quickly, and now everything is kind of back to that $10 range. Even companies that were up to $20 are now flirting in the $10, $11, $12 range. There's certainly been a SPAC correction, if you will, and part of that was, hey, things really got out of control, and part of it was that some of the valuations that were being made at the time, because hey, everybody was rushing to make a deal because they could get a 30% pop. And if you're a SPAC sponsor and you don't have any limitations on when you can sell, if you could just make a deal now and the market's going to give you a 30% pop no matter what, you can sell half your shares or even all your shares. It's easy money, right? You're paying $25,000 for $500,000 in shares that you can sell right away above $10. And no one's the wiser. Now, not all SPACs are set up that way. Certain SPACs require the sponsor to hold. Certain SPACs only release the shares to the sponsor once a certain price point is hit. So certainly things you want to look out for. Certainly a lot of due diligence to do when you're doing those deals. But it's clear to me that at that point, SPACs were bubbly. And on top of that, those deals that were made were sort of un-investor friendly. You know, you were paying $5 billion for stuff that hasn't had a product on the road, $10 billion for companies that won't make any money until 2023, a couple billion for companies that may have like a few $1 million in revenue and exponential growth for some reason in the next couple of years, even though they've been around for a decade already. So a lot of question marks around the investments that were being made here. And that kind of sent not only SPACs, but a lot of post-deal SPAC companies down into the gutter. And we're back in a position where, hey, SPACs are hated again. And that's where they become interesting to me, because you can make this play again. However, it's not as easy as it was before. There's a lot of companies that even when they announce a deal, there's no real pop anymore. So holding a SPAC before a deal is made isn't as enticing anymore, simply because you can wait until a deal is made and still kind of get it at $10 because nothing's really moving. SPACs are kind of hated. But that's a good thing for long-term investors like myself. I can either buy a SPAC that's close to a deal or just wait until a deal is made, do a lot of analysis on that share without the fear of it running up to $20 across 3 days and missing out. And that's really what was driving some of those investments in SPACs before. It was like the hype of like, wow, this is going to be the next 300% return, or I got to get into it. And suddenly people are paying 30% above net asset value for $10 in cash. And it's like, what's going on here? But now you can get a lot of these companies for $10. The deals are starting to come back down to earth because the market showed that, hey, if your valuation's crazy, we're going to punish you. Don't do that. We're not going to love your company. So the interesting companies are back in vogue, right? You can look at some of these investor presentations. You can do a deep dive in them. You can know that, hey, even if the deal sucks and I'm holding stuff pre-deal, I bought it at $950, I bought it at $990, whatever. $950 is probably a bit low for this market. And if I hate the deal, I can get $10 back. Now, if you're the person who is buying stuff at $13 and $14, you're kind of hoping that whatever company they've acquired is going to be a good long-term return, but who knows at this point. That's a few things to keep in mind with SPACs is once this thing is over, right? Once the redemption floor is out there, the floor is gone. It's no longer worth $10. The deal is made, the company de-SPACs, it's trading on whatever valuation the company has been given. And that valuation may be too high or too low. If you look at how SPACs have performed, this is an analysis from Renaissance Capital. They did an analysis of 89 SPAC merger completions between 2015 through July of 2020. And the average loss was 18.8%. The median return was minus 36.1. Only 26% of the SPACs only 26 out of the 89 SPACs had a positive return. So overall, it's been a pretty big loser. And why is that? Well, one, there's an incentive for people to make a deal. The SPAC sponsors at the end of the day only have 24 months to make a deal, and they're competing with 700 other SPACs at this point to make a deal with a company. And that can mean two things. One, it could overvalue certain companies because you've got 5 different SPACs competing for a company that might have been worth $500 million in 2020 and is suddenly going public at $3 billion. And then two, there is an incentive because they get founder shares no matter what and have to redeem the money if they don't make a deal, to make a deal quickly within 24 months. And sometimes it takes a while to find a good company at a fair valuation. And if they're rushing because, hey, SPACs are hot right now, whatever, then the valuations can mean bad things for long-term investors. Secondly, SPACs are inherently dilutive with their structure. The way they're structured with the unit, right, there is an option for people to buy a share of the future company at $11.50. That means that the common shares you're issued, once the company hits $11.50 or more, people will start to redeem those options. And that doesn't bring any additional cash into the company. However, it does issue additional shares that are now diluting the shares that you own. So each share extra makes your share worth slightly less. It's the same thing with founder shares. Suddenly there's founder shares that make up, a couple percent extra over the common shares that were issued. So each of those shares is diluting the shares that you own. Certain deals are structured in a way where the company also gets earnout shares. We were talking about Ginkgo before. This one's actually structured pretty well, but you can kind of see that, hey, we've got 1.78 million shares. However, if you look at the footnotes, this assumes no redemptions and excludes the SRNG Ginkgo earnout shares and the SRNG warrants. So you're talking about, hey, the sponsor shares are in there already, so that's good. However, they converted some of those sponsor shares into an earnout, which means they won't get them until the stock reaches a certain price point, which is good, something you want to see. The sponsor is putting their money where their mouth is, essentially, and saying that, hey, we are not going to get our free money until this reaches a certain price point. You really want to see 100% of these shares be like that, but 30% is better than nothing. There's additional dilution that is going to be granted to Ginkgo shareholders, 180 million shares, which is 11% of the overall shares. However, these are vesting between $12.50 and $20 a share. And there's those warrants, which is 35 million warrants or whatever it was. So suddenly your 1.78 million shares could be 2 million shares, and each share that you own is worth slightly less and less. And depending on how the deal is structured, some of that dilution could happen right away, or some of that dilution could happen later. In this case, it's later, which is good, because then at least they have to hit a certain price point, which means if you're buying at $10, and even if they're diluting at $12.50, you're still making a profit. Same with $20. However, it does put a little bit of a ceiling on your price point as well. There's going to be additional shares coming into the market at $12.50, maybe additional selling pressure. There's going to be additional shares coming into the market between $12.50 and $20, maybe additional sharing pressure. There's going to be additional shares coming into the market at $11.50, maybe additional selling pressure. There's going to be those sponsor shares coming into the market at $11.50, maybe there's going to be selling pressure. There's going to be selling pressure right away, because once this company de-SPACs and goes public, remember, the founder shares are available often to be sold. The company that owns the shares that they have now publicly gotten can sell some of their shares. People in the pipe can sell some of their shares. Investors can sell some of their shares. They actually have to start releasing financial information that might be more clear than what was shown in the investor presentation, and that could be a problem. The redemption itself, if a lot of people actually redeem their money, that means less money is going towards the company, and potentially your shares are worth slightly less as a result of that. There are certain SPACs that may actually fall apart when the redemption happens. If the deal is really bad and 80% of the people redeem their $10, then they suddenly are left with 20% of their money. They either have to raise more via pipe or issue more shares that somebody will buy to get the deal done. And that could be a problem as well. And if the deal gets done and you're the remaining 20%, then you're even further diluted. There's a good study from Harvard here that I'll link in the description that basically says, hey, the median cost of a SPAC when it comes to promotes, warrants, underwriting fees, etc., is 15%. So right off the bat, you're 15% below where you should be at your $10 mark, because there's so much dilution happening and you have to create an additional 14% in value to get past that. So that's why SPACs have a hard time getting above that. And so that's kind of why, hey, it's not surprising that these SPACs are returning 18.8% as a negative, because really, if you think about it, when a deal is made at $10, the acquiring sponsor thinks that, hey, $10 is a fair price. The company that is being acquired thinks, hey, $10 is a fair price. And if that happens at $10 and in the future there's 15% dilution, right off the bat, your stock could be 15% lower if the company doesn't outperform the deal, right? So that's why SPACs struggle to perform well after the deal is confirmed. Not only is there selling pressure, but there's also dilution that happens from all of the various structures that are within this SPAC. And that's why it's so important to take a look at a SPAC when you analyze it and kind of look at the S1. How many warrants are they offering? Where's my dilution coming from? Is the sponsor's interest aligned with mine? Are they willing to convert some of those essentially free shares that they're getting into something that they can only get if the price reaches a certain price point? Because if they're getting all those shares at $10 and they're selling them pretty quickly, that's going to put pressure on the shares. However, if they're saying, hey, we trust that this deal is good, we're going to take our shares and we're going to convert them to shares that we only get if the price reaches $15, then wow, these guys are really putting their money where their mouth is. Same thing if they're giving shares to or shareholders as well. It's like, hey, are those shares given right away, or is there some sort of earnout target that they have to hit? Another way to look at these things, and I look at these when I do my investor analyses, is like, well, what's actually happening with the cash that they're raising? You want the money to be going directly to the company. You don't want the company to just be selling, or people at the company to just be selling. Sometimes you'll see a SPAC that has $1 billion in cash coming in, but only $200 million of that goes to the balance sheet because $800 million of cash goes to people who are getting out of the company. That's not a good sign. If people want to get out, if they don't want to hold the future shares, that's not a good sign. So you have to look at a lot of things when you look at SPACs, when you decide whether or not you want to keep them. However, that really comes into play after the vote and after the redemption, right? This is where the risk of owning a SPAC is really borne by the investor, right? At that point, all bets are off. However, if you're buying near $10 and you're holding before the redemption, the risk reward can be pretty good. Now, obviously, if there's no pop when a company happens and that's the norm, then SPACs are kind of uninteresting again. And that's sort of been the case lately. You can hold this thing for 24 months at $10. They find a company, it stays at $10. And it's like, well, why have I held this for 24 months? I could have invested in other stocks. However, when there are no viable investments that you like, and you just don't want to keep money in a bank account earning 0% interest, but you want some potential upside and you think you have a good management team that is leading a SPAC, you can look at who's involved in the SPAC via their filing, if it's CEOs of companies that have succeeded, if it's a SPAC sponsor that has done a couple of other SPACs that have had great success. Maybe they'll do well with this one as well. It's no guarantee, but hey, maybe they will. If they have advisors on the board that are from companies that you really like, again, there have been duds that have had great teams and there have been great investments that have had poor teams, so it's certainly no guarantee. But you can put that money in there if you're buying below $10. Your floor is kind of close to $10 because the common share really won't drop that far below $10. It can drop below $10. If there was a big market crash tomorrow, and Microsoft suddenly dropped 50% below where it is today, and my SPAC went from $10 to $9.80, I'd probably sell all of my SPAC holdings and buy Microsoft because I think the risk-return reward is better there, right? So people are willing to part with their $10 in cash for less than $10 when there's other opportunities out there that they can use their money on. So if you find those, certainly don't put it in SPACs. However, if you just have money lying around and you are sort of a risk-averse investor in this market because crypto's falling, because growth stocks are falling, because interest rates might go up, because inflation might happen, then hey, maybe you find a good team, you put a couple bucks into a SPAC, you wait for a deal to happen, see what it looks like, and if it sucks, you get your $10 back. That's the beauty of SPACs. When the deal gives you a pop, it's certainly a better risk-reward return than it is right now when deals aren't really giving you much. Right now, you can basically just not buy a SPAC until a deal is announced because nothing's really getting a huge pop. There'll probably be a company here and there that does, but for the most part, 90% of SPACs are still trading around $10 that have announced a deal and haven't consummated it yet. So you can look at a lot of things, and that's why I do my investment presentation reviews. I kind of look at some of these companies, whether it's SPACs I hold or not hold. You have plenty of time to sort of do the analysis because right now SPACs are kind of in the gutter. And there's a reason for that, right? Whenever there's a risk-off market, which is what we're seeing today, which basically means that, hey, people are kind of wary about opportunities that are speculative in nature, they're going to move away from SPACs because SPACs do tend to be speculative in nature. There are companies that have gone public via SPAC, like Utz, the chip company, or Topps, the baseball company, that are mature, real businesses that are growing, but also already have free cash flow and revenue. But there's also a huge bunch of companies that have gone public via SPAC that are like, they're collecting rocks underwater to process them for minerals that are going to be used in batteries. They're developing some technology to recycle batteries, or they're space companies or electric vehicle companies that haven't had a car on the road and won't until 2023. There's, electric vehicle takeoff flight companies that won't have a working prototype until like 23. There's a lot of stuff that is getting, multi-billion-dollar valuations that won't have any revenue until 2024. And with stuff like that, if the market moves more in the risk-off environment, what do you want to be invested in? Do you want to be invested in Coca-Cola that's going to have revenues no matter what? Or do you want to be invested in some electric vehicle company that is 3 years away from having a car on the road and is valued at 10 billion or 5 billion or whatever it may be, right? The answer is probably going to be pretty simple. People are going to dump the speculative stocks and they're going to move into more safer havens or just move into cash. And if you're in SPACs that are pre-merger, you probably won't be hurt too much. But if you're in SPACs that are post-merger and the deals are very speculative, you're going to get boned. And that's kind of what happened in the last couple of months, where some of these deals were kind of looked at again and said, wow, oh, we are paying what for what? They're doing what now? This is $5 billion. Yikes. I should probably not be invested in this unless I'm okay with parting with this money. Because at the end of the day, well, I do think a small portion of these SPACs will be amazing multi-baggers. 10 years from now, you'll look at a $1 trillion company that went public via SPAC that you could have bought for a couple billion. And you say, yeah, what a great investment. And there'll be a bunch in the middle that'll be decent investments, but there's also going to be a bunch that are just garbage plays that are out of business within a couple of years, that are proven to be frauds, that are, some industry that just never takes off, that are some industry that even if it takes off, they were too early for it. And there's other players in the game that got into the space faster or got better later on. And it's so hard to tell. That's the problem with SPACs, right? It's so hard to tell. You're making speculative plays, and that's something you have to be aware of. There is a window of opportunity here to not have a lot of risk, but remember, that window disappears after the redemption period and after the SPAC de-SPACs. And you also remember that window only exists if you're buying common shares at $10 or below, because then your downside is relatively limited. You might still lose a couple percent, but you won't lose a ton. And your upside is, potentially infinite if you get an amazing deal. If SpaceX goes public via SPAC or something, your SPAC's going to explode, but that probably won't be the case. And that's the beauty of SPACs, right? You kind of have more control over what you want to do with your money. And you have more access to companies that you would not otherwise have access to. A lot of these companies that are going public via SPAC today, maybe some of them are too early, but a lot of them would probably have IPO'd in a year or 2 or 3, and I wouldn't have access to them at this price point, right? But I do have access to them via SPACs. And I do have the ability right now, with the way the SPAC market is handling these companies, to analyze them pretty quickly and readily without the fear of the price escaping from me, right? The SPACs are sticking around $10. I can do my due diligence. I can scour the S1s. I can scour the investor presentations. I could do analysis on the company, and I can really dive into it. And that's what I want from a SPAC market. I don't want a market where I have to pay $14 for $10 in cash that we saw a couple months ago. That's not a good long-term play for me. I want a market where I can buy $10 in cash for $9.80. And, I have maybe a guaranteed 2% return or maybe more. That's good for me. If I don't feel like investing in crypto right now because I feel like, things are murky, if I don't feel like investing in growth right now, maybe I just put some money in SPACs and sit on them and see what happens, because hey, there's going to be plenty of companies that are amazing that are going public via SPAC, and it would be a shame to miss that. However, it's still important to understand that at the end of the day, once the SPAC de-SPACs, all bets are off, and you could be looking at an 80% loss in a year, like some people are with some of these investments, and that's not a good thing. So risk reward is good before the redemption. Risk reward certainly skews more towards the risky after the deal is confirmed that the company de-SPACs. Not to say that you shouldn't hold after the deal is confirmed, but remember, dilution, first opportunity to sell for a lot of owners, and other things might push the valuation of the stock down a bit. And if a deal runs away from you, don't chase it. I think that was the concern. I think that was the mistake a lot of people made when the SPAC bubble was forming. The company would announce it'd be a really interesting deal. Suddenly the stock would be at $25, and people would be like, "Oh crap! If only I owned that stock, and I better get into this other SPAC that's now at $12 for $10 in cash." And then other people would be buying that stock at $25, thinking it would go to $50. But you have to remember, the SPAC sponsor thinks it's worth $10. The company thinks it's worth $10. Certainly some are going to be wrong on both ends. And certainly some of these SPACs are now trading at $40 to $50. But a lot of those SPACs that were at $40 to $50 below a couple months ago are back to the $10 to $15 range. So you have to be careful with SPACs. You have to understand what you're buying. You have to understand the dilution. You have to understand the timeline. You have to understand that, hey, this redemption feature only exists for a certain period of time. If that disappears, your floor is zero. Your upside is certainly there, but your floor is no longer $10. So that's a SPAC, guys. That's my thoughts on SPACs. Let me know what you guys thought. about the video. Let me know if it was too much information, too little information. Leave a comment down below if you want me to cover anything else. If you have any additional comments, if I missed anything, which I'm sure I did. Leave a like, subscribe. Thank you to all my subscribers that are out there. I appreciate you joining the channel, joining my journey. Hopefully I can teach you something. Hopefully we can grow our portfolios together. Remember, guys, I am not a qualified financial advisor, just doing this for fun. Please talk to a qualified financial advisor before making any investment decisions, especially when it comes to SPACs. I will do more of these educational videos in the future. I'll leave the links to all of this stuff down below if you want to check it out. Thank you for watching, and have a great rest of your day. Appreciate you guys.